Welcome back, investors, to Ticker Time News. I'm Adam, and boy, oh boy, Winnebago's earnings and revenue upside in Q2 have proven insignificant to investors. As of today's close, the stock was trading about 26.5% lower on the year. Now, despite trading at a solid valuation around 6 times forward earnings, and despite Winnebago's consistent measures to return cash to shareholders through recurring dividend increases and share purchase programs. Oh, and this would be a great time to mention that I want you to beat the market with us by clicking the first link in the description. Okay, a barrage of headwinds remains strong enough to douse any potential sparks in reversing Winnebago's downward trend. For example, supply chains are expected to remain consistent throughout fiscal year 22, driving up the cost of materials. Adding to that, the labor market is still tight. Even though those particular hurdles are starting to show improvements, other obstacles are popping up. First, gas prices are hitting record highs in areas all across the US and in some of Winnebago's overseas markets, upping the cost of operating towable and motorized RVs. Secondly, Fed Chair Powell noted this week that inflation remains too high, increasing the probability of larger interest rate hikes going forward, which would make financing highly discretionary RV purchases even more expensive. Also, Winnebago's biggest rival, Thor Industries, ticker symbol THO, posted its biggest earnings beat in the last 5 years and solid revenue upside in its earnings report earlier this month. So, even though Winnebago's report ends in February, investors may have already priced in most of the good news from its earnings report. One such piece of good news was that adjusted EPS jumped 42% year over year to $3.14 a share, a typical double-digit beat for Winnebago. However, in light of soaring input costs and other supply chain costs, Winnebago's earnings growth was a positive standout in the quarter. Revenues grew too, rising 39% year over year to $1.16 billion, driven mainly by towable sales, which shot up over 47% to $646.6 million. Adjusted EBITDA margins also expanded 140 basis points year over year in this segment due to ongoing price hikes. Winnebago grew its RV market share to 14.3% on a trailing 12-month basis, a 1-point climb over its quarter a year ago. I suspect most of Winnebago's gains come from its towable segment, as Thor said earlier this month that it saw a 40 basis point decline in market share for towables. But Thor's motorized segment gained 330 basis points of market share during its most recent quarter. So we can infer Winnie's got the better towables and Thor's got the better motorized RVs, right? Well, I guess we should probably leave that up to the consumer. The bottom line, Winnebago's earnings showed that demand is still really strong. But since there are a few headwinds facing the RV industry over the short term, investors have opted to set up camp elsewhere. COVID ignited a renewed interest in camping, boating, and RVing, basically being in the great outdoors, and remote work has helped to sustain that demand. But with soaring gas prices, rising interest rates, and a struggling supply chain, this could lead to Winnebago, unfortunately, to face continued selling pressure going forward. What do you think about Winnebago's earnings and those upcoming headwinds? Let me know in the comments below, as your comments help us all to better understand this stock. Smash that like button, share this video, and beat the market with us by clicking the first link in the description. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.